The Americans, they've tried before. They didn't give enough money to their traders, and it didn't work, but they're much more serious about it now. The Americans and the national oil companies are among the biggest recruiters at the moment of traders worldwide. The European majors, they still have a few years of really lucrative trading, but competition is coming. The world's largest energy firms, collectively known as the majors, they've done really well through this oil shock. And one reason is that they've drilled oil and they've refined it, and they sold it at a higher price, which is not surprising to most people. But another reason is far less known, which is that they've done a lot of trading. The Iran war has really shown the extent to which this activity, trading, has become central to these businesses.
Let's start with what you mean by trading.
So trading can be defined in opposition to marketing. So marketing is selling what you produce, distributing it to the global market. Trading is different. Trading is buying someone else's produce. So in that case, crude oil or refined products like diesel or jet fuel, and selling it to whoever wants it most at the highest price possible at a profit. So if there is a war somewhere, there's a supply shock, then in certain places there will be shortages. There will be also a rush for getting the product now instead of later. And so you'll have all these differences in price that traders can seek to benefit from. And so over time, the majors have learned to do that really well, especially the Europeans.
So which companies are we talking about then?
Companies like BP and Shell, which are mostly British, and TotalEnergies, also known as Total, which is French.
Total, no?
Like Total. So they trade, by our estimate, 40 to 50 million barrels per day of oil and gas. It's 5 to 10 times more than what they produce. So it's huge. It just shows how central trading is to these businesses. And probably, during this very volatile period, there's been more because they've shifted more barrels. And it's a very, very lucrative activity. The majors don't publish data for their trading desks on profitability or anything else, really. It's very secretive. But the estimates we've got from a number of sources suggest that this trio, so BP, Shell, and Total, this year could earn in between $15 to $20 billion in profit, which might be 1/5 of their profits. So huge, a lot. And this might add, up to 1/3 to their return on capital. So something that shareholders will like a lot. Trading profits alone explain why the Europeans have outperformed the American majors so far this year, since the crisis in particular, since February.
Why should that be? Why aren't the American majors just as good at this secretive game?
It's largely a product of history and geology. So the American majors, they've always had access to vast resources in the ground. They have a lot of oil and gas. They also have a vast domestic market that they can sell to. So they can take advantage of both. The Europeans, they don't have that, neither of these things. So what they've had to do, pretty much since their formation, is to go abroad and produce the barrels there and then distribute it to the global market, which worked fine until the 1970s when there was a wave of nationalizations in the Gulf, in the Middle East, and they lost access to this oil. So they had to go abroad and buy barrels from somewhere else. So BP did it first, essentially, discovered that it could buy the barrels it didn't need and resell them at a profit in the 1980s. And then in the 1990s, it's Shell and Total did it then because oil prices were pretty low. They needed to boost their returns, their profits, and they thought that was a way maybe to diversify.
So that's a lot of the history of this trading arm for the majors, but you say that they're really good at it. What does that look like? How do they do it well?
Yeah, so the secret sauce of these trading operations is the intelligence, the information they can harness from the vast operations of the mothership. So, the majors are huge companies. They've got lots and lots of refineries, so oil and gas fields, refineries, terminals, storage facilities, tanker fleets all around the world. And as the majors operate this big global network, there's a lot of information that surfaces about the amount of supply, the amount of demand there is in the world, and therefore the direction of prices. And so using that intelligence, they can harness volatility. So that's how they do it. And that's the reason why, when I speak to sources, they say these operations, they basically never lose money. They make bad bets sometimes, but on an annual basis, they find ways to correct that. And so in worse years, they just make a bit less. In good years, they make a lot of money. And so
This being a good year.
it's been a pretty good year, I think, for them. Yeah, I think so. Yeah, really, really good.
But it's got to require quite a few people to be chasing all of that information and compiling it into a bet.
That's what's really interesting, because these teams, they are at the same time large and pretty lean. You maybe have like 60 to 70 traders. And then if you add, shipping, financing, risk management, all the sort of support functions, then it would be, 1,000 or 2,000, which seems quite a lot. But at the same time, these companies, they have like 100,000 maybe people. So it's a really small percentage. So if you take the profit that they make and you divide by the number of people that they employ, it's a really high profit per head, In a good year, maybe like $10 million.
So there's a lot of incentive then for companies that are not the majors, European majors, and even the American ones, to get in on the game, if you say it is so lucrative.
Yeah, absolutely.
Or is it something that just only works at scale in this way?
It only works at scale, and which is why, so the Americans, they've tried before, the American majors. They tried before, and it didn't work because they did it half-heartedly. They didn't give enough firepower, enough resources, enough money, basically, to their traders. So that limited the scale of the bets. And also they did not give them enough independence. They were forced to sell the barrels of the company, basically. But they're much more serious about it now. They're much more determined to do it. And so you're starting to see that in the way you speak about it. And also the national oil companies, which are the big state-owned oil producers, which are in the big oil-producing countries. So in the Gulf, for example, Saudi Aramco, or ADNOC, which is the Abu Dhabi National Oil Company. They also want to do it. So I spoke to one recruiter for this piece, and he said that the Americans and the national oil companies, Exxon in particular, and ADNOC, are among the biggest recruiters at the moment of traders worldwide. So they're really quite keen to do it.
The right number of people, the right number of dollars to spend.
That's right. But even if they do that, to your first point, closing the gap may still take quite a few years, because it really is quite a finely tuned machine, a well-oiled race car that you need to put together to make it work. You prepare the car, you do a race during a crisis, you look at the data when it comes back, you make a few tweaks, and then you do another race. But this could take many, many cycles before you get very good at it.
That is to say that the European majors will stay on top for some time yet?
So I would say the European majors are, they still have a few years of really lucrative trading. The golden goose is still there. But competition is coming. So in a few years' time, maybe profits will shrink, and the engineers, not the deal makers, will be on the ascendant once again. Maybe they'll take back the building.
Matthieu, thank you very much for your time.
My pleasure, Jason.